Hello and welcome to Smartkarma's corporate webinar. We're very happy to have with us UOB's IR team led by Yida today. And with us, we also have Daniel Tabbush, our Smartkarma Insight provider, who will engage with the fireside chat with him. So it will start off with Yida giving us a short presentation about the company and then lead into the fireside chat. For all of you attending live today, I invite you to send through your questions in the Q&A tab at the bottom of your screen. Daniel will be sure to weave them into his questions as he goes along. And right through, I'll be sharing a few useful links for you, so do look out for them in the chat box. And with that, I hand it over to Yida to take it forward.
Thanks, Anisha. Let me share my screen. So good afternoon, everyone. I'm Ita from the UOB IR team, and I'm happy to be on this webinar to share more about UOB. So some background in history. UOB is a leading Southeast Asian bank headquartered in Singapore. It was founded 87 years ago in 1935 by Datuk Wee Keng Chiang. And throughout all these years, the founder's family has always provided stewardship of the bank. To this day, we remain an owner-operated bank. Datuk Wee's grandson, Mr. Wee Ee Cheong, is our current CEO. He's the third generation CEO, and his family remains the largest shareholder with an 18% stake in the bank. And having run the bank for the last 87 years, the family obviously takes a long-term view on the business. And this means that, long-term shareholders do not need to worry about corporate governance issues where management interests are not aligned with shareholders' interests. And in this case, the management is the largest long-term shareholder. More importantly, there's skin in the game. Every credit decision, that this bank undertakes is well considered. Any NPL that blows up, you can imagine the pain that can be felt, by the family stake. And this is one of the key things that makes UOB different from the other Singaporean banks, because we are owner-operated. We can afford to take a long-term view and not be swayed by short-term interests. And most importantly, like I said earlier, there's skin in the game. Now, a quick look at the different business segments that we operate. UOB is obviously a familiar name in Singapore. Not only are we a household name in the retail banking space, where we are a sizable player in the mortgages, credit cards, deposit accounts. We're also one of the leading SME banks in the country, and this is what we are known for: championing, supporting businesses, supporting enterprise growth. And as you can see, we have won numerous awards for the best retail bank, best SME bank in the country. And besides retail and SME banking, what many people may not know is that we have been steadily growing our corporate and institutional business. As you'll see in later slides, this part of the business has been growing very well and now comprises a big portion of the bank and the business today. Singapore remains our home and our base. More than half of our profits come from Singapore. In terms of domestic market share, we control about 20-24% of Singapore dollar loans and deposits. Now, since Singapore's independence, we have grown from strength to strength. As you can see, back in 1980, our net profit was only 92 million. More than 40 years later, this has grown 44 times to more than 4 billion as of last year. And all this was achieved as our franchise across the region expanded, growing both organically and through a series of strategic acquisitions over the years. This happened in two distinct phases. The first phase was in the 70s and 80s, mainly consolidation in Singapore. The second phase happened right after the 98 Asian financial crisis in the early 2000s, where we expanded our regional presence by acquiring some of the regional lenders. So the last time we did a major acquisition was 16 years ago. But looking ahead, we are looking to expand our franchise even further with the proposed acquisition of Citigroup's retail businesses in Thailand, Malaysia, Indonesia, and Vietnam. And if you have conviction in the growth potential of the region, you can continue to expect this upward trend in earnings to continue into the long term as we dig down deep with our franchise. And the other point to note is that this profit growth that you see had gone through many volatile periods, like the 98 Asian financial crisis, the global financial crisis in 2008, the 2020 oil price crash, as well as the ongoing COVID pandemic. The next slide, this slide shows our footprint in the region. As you can see, while Singapore is our home base, like I mentioned earlier, our franchise really spans the Southeast Asian region all the way into Greater China, in South and North Asia. And we are proud to say that we have the most comprehensive network in the Southeast Asian region. Why is this important? Because this allows us to tap into the potential of the region. You can see all these key trends being summarized in the charts on the left over here. This region is close to China and the major markets. It's a combined population of more than 650 million people, more than half of its population being less than 35 years old. Southeast Asia is the third largest population base after China, after India, and almost all the economies are open economies linked to international trade and global supply chain. And this has led to decades of improving income levels. Much of that is driven by increasing trade as well as FDI flows into the region. So at UOB, our integrated regional platform allows us to effectively tap into these cross-border flows. And because of our comprehensive regional footprint and our deep local knowledge, we are much better positioned than other banks to help our customers do business in the region. We can help to bring Singapore companies into other parts of Southeast Asia, or the likes of Thai companies into Singapore to do fundraising. So this is one of our key differentiator. Slide 9, this is our strategy in a nutshell, how we see ourselves adding value to customers and society. And at the crux of it lies our DNA as a financial intermediary with the most comprehensive network in the Southeast Asian region. Because of our regional franchise, our wholesale banking business is able to help corporates, business customers facilitate that cross-border transactions when it comes to trade or investments. And as one of the leading banks in the region with strong local currency franchise in our chosen markets, we are able to serve the mass affluent in the consumer banking space. Over the years, from simple over-the-counter transactions at bank branches, we have evolved to deliver an omni-channel approach towards customer engagement. This enables us to serve our retail customers through the channel of choice as we grow alongside them on their financial and wealth journey. And because we are so entrenched in societies and economies in the region, we're acutely aware of how customers and businesses are evolving as societies adopt more sustainable lifestyle. We see this, evolution into ESG sustainability as a huge opportunity, and we have been at the forefront of this space, coming out sustainable financial solutions to walk alongside our customers in this sustainability journey. The next couple of slides will touch on these topics in detail and highlight some of our progress we've made so far. I'll first talk more about the Citigroup acquisition. So this deal with Citigroup is actually a game changer for us in Southeast Asia. It will deepen our presence in the region with the right strategic customer segments, bring on board, complementary staff force as well as product suite. And once completed, this deal will double our retail customer base to 5.3 million customers in that 4 markets outside Singapore. And this acquisition will help us accelerate our growth by 5 years ahead of schedule. And, we'll cover more on our retail business. So this slide shows the highlights from our retail business, which currently contributes about 40% of our pre-tax earnings. Gone are the days where retail banking involved providing staple banking products like mortgages and deposits to our customers, over the counter at the bank branches. Times have changed and customers' needs and technology have evolved. As a person's income grow along with his career and life cycle, his financial needs will clearly evolve as he amasses more wealth, approaches retirement. And our philosophy is to stay engaged with them, serve them through the channel of choice through our omni-channel capabilities. Our customers can bank using our award-winning digital banking app called UOB Tomorrow to make their payments, funds transfers, invest and plan their financial journeys anytime, anywhere on the go. In the region, what UOB Tomorrow has done is to enable us to transcend the limits of physical branch network. We're able to acquire new customers at scale and serve them in a more cost-efficient manner. In the first quarter this year, we digitally acquired 140,000 new customers. By end of 2020, we're on track to acquire about 500,000 new digital customers. And beyond digital, face-to-face engagement with our clients also becomes more important as they move up the wealth continuum. As their financial needs evolve, we also have RMs catering to affluent customers who have more sophisticated financial needs. So as of March 2022, in the first quarter, our AUM actually increased 3% year on year to a new high of 140 billion. Of these, about 60% were from overseas customers. So as you can see, we can engage and serve our customers through multiple avenues and touch points. And this is something that some of these new digital banking entrants are unable to do. We provide access to one of the most comprehensive branch network across Southeast Asia. Again, something that not many banks are able to do. And this is where and how we have differentiated ourselves. Complementing our omni-channel approach is our ecosystem partnerships. These partnerships helps us to lower our cost of acquisition as we scale our base in the region. We are very pleased that today about 30% of our digitally acquired customers are through all these partnership referrals. We started this digital transformation journey back in 2016. We have been investing in our digital capabilities, transforming our physical touch points, and today we are seeing some of the fruits from some of these investments. We will not rest on our laurels and will continue to up our game to delight our customers as the market becomes more saturated and crowded with some of these new digital players. Moving on to the wholesale banking business, which contributes about 60% of our pre-tax earnings. We've been focusing on enhancing our capabilities, diversifying across geographies, sectors, and products. So you can see that our cross-border income had grown 11%. Now it accounts for about 31% of our group wholesale banking's income. We expect this figure to continue to grow as the pandemic has accelerated the pace of supply chain diversification right into Southeast Asia. Companies, manufacturers are adopting a China plus one kind of strategy. The reopening of borders and markets also help to boost trade and financing opportunities that come with it. UOB is well positioned to ride on these trends because of our, again, the regional comprehensive regional network and the deep local knowledge that we have in all these markets. Our sector-specific insights and solutions also help to synergize businesses to mitigate risk across the supply chain. One area which I would like to highlight and where we have been able to carve out a niche is this our niche with the global funds, banks, the MBFIs in the region. Our financial institutions group have been very successful in capturing all these flows in the region from this segment. So you can see that income from this, what we call the GFIC, actually grew 25% in the first quarter. And the progress we have made with wholesale banking is evident from the results. To solidify our momentum, we have continued to invest in developing our digital platform. We have successfully rolled out our digital cash management platform called UOB Infinity for corporate clients in the region across 5 markets. We have seen very good traction. Adoption has been very strong in the markets. User numbers grew 6% year on year. And in terms of our corporate customers' CASA balances, that grew 19%. And you can see from this slide, digital banking transactions, cashless payments, they have both registered very strong double-digit growth. Sustainability is something that is quite top of mind today. And here's some of the efforts and the progress we have made. And in line with the UN 2030 Agenda for Sustainable Development and the Singapore Green Plan, we're committed to play our role in helping this region in the transition to a sustainable and climate resilient economy. Last year, we have already achieved operational carbon neutrality. That means our direct operations are now carbon neutral. We do not just talk about sustainability, but we do actually walk the talk. And in our opinion, there are lots of opportunities for UOB as societies embrace greener and more sustainable lifestyles. According to Bain, they see a 1 trillion opportunity in terms of green and sustainable opportunities in Southeast Asia. So to capture these opportunities, we have come up with numerous sustainable financing frameworks to help our customers in the sustainability journey. We are pleased to share that as of the first quarter in this year, our sustainable financing portfolio has actually totaled more than 18 billion. And last year alone, this portfolio grew by 5.5 billion, 50% higher than the previous year. At the same time, we're also seeing a very strong growth and interest in responsible investments. Total AUM in what we call ESG-focused fund investments have now hit an all-time high of 13 billion. So quarter on quarter alone, that has registered 45% growth for us. And to give an example and some sense of the tangible environmental impact that we have made through various initiatives such as our U-Solar program, which is Asia's first solar industry ecosystem. We have contributed more than 236,000 tons of CO2 equivalent of annual avoided greenhouse gas emissions. Now, moving on to this slide, balancing growth with stability. And this is a philosophy that my CEO has always advocated. The chart on the left shows our loan base and how it has grown over the years. And in the span of little more than 20 years, our loan base has, increased by more than 10 times. But lending money is always easy. Anyone can grow loans because there's always loan demand. The question is, whether we are able to collect back what we have lent out and how much of the loans will go back. So on this point, I think we are very proud of our achievements. We have never compromised asset quality in our quest to grow. You can see on the chart on the right, we were hit badly in the 98 financial crisis. There was no way we could avoid the pains because we were at the heart of this economic upheaval in the region. But what we did was to learn from these mistakes. We pick the right customers, we stand by them through thick and thin, we help them right through the various macroeconomic cycles. As a result of our very careful credit policies, you can see that our NPL ratios have improved significantly from the post-Asian financial crisis years and has been maintained at a very low, stable level between 1% to 2%, despite all the crises that we've gone through since 2007. Some of you might be interested, what is in our loan book? This slide shows where all the money goes. By geography, half of our loans are from Singapore. The remainder is spread out across the Asian region. Key markets are Malaysia, Thailand, Greater China, Indonesia. In terms of economic segment, the loan book is very diversified, as you can see, and a lot of it is well secured. Finally, in terms of customer segments, corporate loans, account for more than half of our book, while consumer loans account for about a third of it. As a commercial bank, our business is mainly funded by customer deposits, right? The deposit-taking business is the lifeblood of the bank, and it provides what we call the raw materials that is necessary to undertake our overall business. And this is arguably the hardest part of banking. Like I said earlier, lending money is easy, but asking people to put their money with you is much more difficult. Not only does it require regulatory license from very stringent regulators, it also requires trust from depositors that their money is safe with you. And this trust, has been forged over the past 9 decades. And as you can see in the following slide, we have always been very profitable, and we have never, come to shareholders asking for money. And this is why we have been one of the most trusted franchise, not just in Singapore, but across the region. This is reflected in our ratings from AA ratings from our credit rating agencies. These AA ratings from all 3 international rating agencies are amongst the highest in the world. You can see that our deposit base has grown from strength to strength, increasing by more than 8 times in a little more than 20 years. Today, about 54% of our entire deposit base of 362 billion is made up of sticky low-cost CASA, right? Moving on to slide 18. So what do all this all mean, right? What do all this amount to? All these loans, loan growth, deposit growth, balance sheet growth, well summarized by these 2 charts. On the left, you can see that total income or our total incomes or revenues, while on the right is our net profit. What is obvious is the trend in both revenues and profits. We are generally making more money over time. And even during difficult periods like the financial crisis in 98, 08, or even the recent COVID pandemic, you can see that we are still making money. Sure that the growth in earnings may fluctuate, for 1 year or 2, but we always weather through these periods emerging stronger. Now, to reward shareholders, our long-term shareholders, we currently have a policy of paying out about 50% of our core profits. This translates to a total dividend per share of about $1.20. That was back in 2021, amounting to about $2 billion. As long as we maintain our profit growth trajectory, shareholders who stand by us, they can look forward to higher dividends over time. Of course, you see the dip in 2020. That was because MAS kept dividends to 60% of the 2019 levels due to COVID. Now, one final slide. What you get when you invest in UOB, essentially four things. A Singaporean bank that is intimately tied to the growth and rising affluence of Southeast Asia. An owner-operated bank where the interests of the long-term shareholders are aligned with management. A bank that has weathered through numerous ups and downs, including world wars, epidemics, economic cycles over the past 87 years. And a bank that consistently delivers on growth, earnings, and dividends throughout history. Now, I'll end off by saying, right, if you look around the different stock market indices today or over the past few weeks, look at the different stock counters all in a sea of red, and you juxtapose that with UOB, I guess that pretty much summarizes the title for this today's presentation, which is, UOB being a safe harbor in ASEAN. With that, thank you for listening to this presentation. I'll hand the time over to Daniel, who will moderate the Q&A.
Thank you, Ida. So at this stage, what we could do is we could open up the floor to Q&A. And remember, what people can do is send through questions on their computer, and then we will go through them. And as these are coming through, I'd like to just start it off, if that's okay.
Sure.
With the first question on margins and interest rates. Now, of course, the Fed just raised rates again, so that's very new. And SIBOR is running much, much higher. Can you just walk us through how does UOB manage margins and net interest income as rates are rising? Because we've got costs and loans. There's two impacts here.
Right. So I think maybe I'll just share some high-level guidance in terms of what we are going to expect to our NII line. Right. So of course, the Fed fund rates, they've just announced a 50 basis point hike. In terms of our house view, in fact, we're expecting a total hike of about 250 basis points for 2022, and another 50 basis points for 2023. So altogether, our house view is looking at a 300 basis points increment in the Fed rate hike. What this translates to our margins, right? When you have higher Fed fund rates, naturally that will translate to higher margins for us. So we are expecting for every 25 basis points increase in the Fed fund rates, we are looking at about 4 to 5 basis points increase in our net interest margin, mainly flowing through the loan margins. And you're also going to see that also translating through to about 150 to 200 million in terms of incremental net interest income, right? So if you work out the math, 300 basis point increment, that pretty much could bring you to about more than $2 billion of incremental top line revenue. So we are very optimistic about how this increase in Fed rate hike will be positive for the bank. But however, I think it's important to note that there's about a 3 to 6 month kind of transmission mechanism lag between the Fed funds, the raising of the Fed fund rate and how it translates into our margins. So you would need to time that 3 to 6 month lag because for us currently about 40% of our book is in SGD, about 20% is in USD. So definitely we need to take into account the lag out there. And then in terms of funding today, I think we are very well deposit funded bank. I mentioned earlier, 54% of for 54% of ours is actually CASA.
Yes.
So apart from that, the other point to note is that we are a AA rated bank. So that gives us another competitive edge when we go out there to do wholesale funding. So these are how we continue to compete. These are all our competitive advantage out there, in pricing space.
Okay, Ida, that's great. We've got questions coming through. The first one that's come through is about the loan book in Greater China. The question that the client is concerned about the potential impact for the China-Hong Kong loan book from what's going on up there, where it looks as though UOB has about 16% of total loans. Any comments on that?
Yeah, so for us, I think we're very comfortable with our exposure in Greater China. For us, our Greater China strategy is about capturing like I mentioned earlier, right? Capturing the cross-border flows from China into Southeast Asia. My management always like to say this, right? We are making money from China rather than in China. So it's about these cross-border flows that we are facilitating. So in terms of onshore exposure, I think we are very comfortable with what we have out there. I think a lot of focus is on China real estate, right? So our China real estate exposure is actually very small, at about 1% of loans. Overall, I think we are very comfortable with what our operations there are in Greater China. In Hong Kong itself, we only have one single branch, which serves as a point of origination for loans and all that. So we do not really have a retail banking franchise. We aren't really big. If you compare across the three Singapore banks, our Greater China exposure is probably the least, right? We are still predominantly a Southeast Asian focused bank, and what we do is to bring all this China originated loans into Southeast Asia.
Okay, just to be clear on that 1% that you mentioned for property loans in China, is that 1% of your total book or just your
total book?
Okay, just want to be clear on that. Okay.
Total book.
There's another question about special dividends, which were paid many years ago and for many years, from 2010 to 2018. The question is really saying, if now there's no restrictions on dividends from the MAS, would there be a reason for UOB to start these special dividends once again?
I think if you have looked at what we have paid out for 2021, that is actually $1.20, and that's 50% of 50% dividend payout ratio. So that is in line with what we have been guiding. So in the past, what we have done is maybe pay about 40% in the interim dividend, and then we do a top up via the special dividend. But today, I think we are more comfortable paying, standing by our dividend policy and paying out 50% of the amount without the special dividend. Eventually, what shareholders get is still the same, right? It's still the 50%. So how shareholders should compute is, if we make $4 billion, 50% of that is $2 billion, and that $2 billion will be distributed to shareholders.
Yes, that makes sense. A question is asking about the driver of the sharp improvement in profits over the last couple of years. Can you comment on that?
I think there are various growth drivers out there. I think our wholesale banking business has been doing very well. As I've shared earlier, we have been diversifying across geographies, products, different geographies. So that has contributed significantly to overall top line as well as bottom line, right? So one of the key areas that I have singled out earlier is this performance by our global financial institutions group, where we have been banking the likes of financial sponsors, non-bank financial institutions, the other FIs. We provide all this advisory, structuring, fundraising capabilities. All this have actually contributed to the growth in the area. And in terms of fees, you've seen that alongside our loans, very strong, healthy loan growth. We have also been growing this fee line called the loan-related fees. So that has, this quarter, we've registered a record, I think 14% growth in loan-related fees. That is probably something that you want to pay attention to as we step up our product capabilities. We have brought in more of these bankers with the connections, the network, and the product capabilities. So we're now able to better bank and service clients in this segment. Okay. In terms of geography, I think we continue to be in probably the past year or two, we are more focused on the developed markets, given the market volatility, right? So we have been growing not just in Singapore, but also the DM markets like Singapore, Australia, UK, US. These are all very strong, good jurisdiction where we're able to get growth as well as pretty good asset quality.
Okay, that's excellent. One thing that was interesting in your presentation is about the acquisition of the Citibank credit card clients in the 4 countries in ASEAN, and you were indicating that gives you a lot more clients. I think you mentioned about doubling your client base for those countries. Can you talk to maybe the potential for contribution, maybe ahead of what you were expecting? And I suppose that is almost exclusively in fee income?
Yes. So what we're looking at, as we have announced during the acquisition itself, this acquisition will actually contribute on a pro forma basis, a 40% income uplift across our operations in the 4 ASEAN markets: Thailand, Malaysia, Indonesia, and Vietnam.
1-4.
We expect
1-4.
4-0.
4-0. Okay, just to be clear, 4-0.
Right.
Okay.
So income in these 4 markets. We also expect the acquisition to help lift our ROE to more than 13% by 2026, from the about 10% that we are currently at. So these are some of the key figures that we are looking at. So as you know, right, retail banking really is about scale. When you have the scale, you are able to lower your cost of acquisition, your cost of servicing, right? So this is where we are able to reap the synergies, right? So when we did our due diligence and all that, there isn't much duplicates between the UOB customers in these markets as well as the Citi customers. It's a very complementary fit. So it's a perfect, in terms of a jigsaw, it's a perfect fit for us.
I'm just going to clarify for the audience and for the recording. The 40% uplift is for those markets, for the income that you have in those markets. And the
Correct.
ROE improvement is for the group as a whole, from 10 to 13.
Yes.
Okay, that's okay, just to be clear. That actually was also asked by someone in a different.
Also, just to be clear, for the record, that the ROE improvement is also because of rising rates, productivity gains, and large scale, right?
Okay, it just adds to that. It's not the only driver for that. Okay. Okay, one question, which is, a short question. I'm not sure if we've totally covered it when we talked about Greater China. The client is asking the effects of QT on UOB, which I presume means quarantine.
Sorry, quarantine?
I presume they mean China, and Hong Kong.
Okay. So well, I think definitely the situation in China, they are adopting a dynamic COVID-0 kind of policy, and definitely you see a lot of supply chain disruptions. Some of these chips cannot be shipped out. A lot of disruptions to the entire global supply chain. So what this is pretty much a dampener for growth globally. But I think for us, we see the silver lining because, of course, amongst the 3 Singapore banks, we have the least exposure to Greater China.
Yes.
We are very ASEAN focused. Like I casually mentioned during my presentation, that a lot of these manufacturers and factories and all that, they are adopting a China +1 strategy, right? Because they have seen from this COVID pandemic that you can't just rely on China alone. You want to have additional spare capacities. So Vietnam is a prime beneficiary out of some of this supply chain diversification as part of this China +1 strategy. So for us, we have, like I mentioned many times, we have the most comprehensive Southeast Asian footprint. We're able to help support all these clients in setting up their operations and all that. So not just in Vietnam, the likes of Thailand, Indonesia, Malaysia, they are all prime beneficiaries depending on the type of industries they're in. For example, automotive, they'll go to Thailand, semiconductors and all that, chips, they'll go to Malaysia. So ASEAN as a whole, I think is quite a prime beneficiary from the continued lockdown in China. So we see a silver lining in this aspect.
Thank you. On what we talked about before on the Citi acquisition, one client is asking if we will see this in your secured loan book primarily, or mostly in payment transaction fees or wealth AUM. Where should we see most of the new income stream coming through?
So Citi acquisition is mainly unsecured, right? So credit cards and all. Predominantly, these are all credit card customers. But
Yes.
what we are trying to do here is then, why I say it's a complementary fit is because we can then upsell mortgages and all that. For example, Thailand or Malaysia, we are very strong our franchise is strong in terms of providing mortgage advisory and this type of business. We're able to complement and upsell and cross-sell to them. So instead of having just now that we know they are a card holder, once they migrate over, we can upsell all these other products to them. So they become a multi-product holder with UOB. And this is where we see the synergies and the uplift that will come from this acquisition.
Okay, that will clearly be secondary. So at the very beginning stages, it's the unsecured loans. So the interest income plus the processing fees. So two components.
And then also to add that, this is pretty much a good quality book that we have acquired, because we have done our due diligence. We have looked at the 30 days past due, 90 days past due kind of records from the 30 customers. And the best thing is, throughout this pandemic, we have seen that credit behavior, the credit history, right? And they have been able to weather through this cycle. That pretty much gives us that assurance, that this is a good quality book that we're acquiring.
Good. Just going back to rising rates, we talked a lot about the expectations that you have and the impact on sensitivity for income, for net interest income. Are there any other secondary impacts that you see for Singapore in general with rising rates?
I think what people might be thinking about could be, impact on asset quality, whether borrowers are able to continue to service their loans. This is a very good question. In fact, we've just checked with our colleagues from risk management. We've done, our internal stress tests and all that. Say for example, our corporate banking customers. Well, generally we are comfortable, and they are comfortable, based on what our in-house forecasts and projections. Our customers should be comfortable with the impact from the rising rates.
Okay. That's obviously that's very good to hear. I guess we don't have any questions right now from the floor, but I'm very happy to talk further. I know that your bank is seeing some fairly good loan growth, and the banks in Singapore at the moment stand out with some of the best loan growth in the region. I'm just wondering what your thoughts are, and you've got a good view across ASEAN. How are you seeing the differences in loan growth that you are looking at across Asia, and is Singapore that much stronger right now than the smaller ASEAN countries in terms of credit demand?
I think for us, given that we are all coming out from, the COVID pandemic, it's recovery phase. Naturally, there's a lot of credit demand out there in Singapore, as well as in the region, as well as globally. But for us, we are pretty selective with the type of credit that we want to do. So we have been very focused on, if you looked at our where the loan growth has been coming from, it's mainly Singapore, as well as the DM markets, right? The good jurisdictions, right? So we have been pretty much selective. But moving forward in the second half, what we're looking at is we're expecting ASEAN and Southeast Asia to step up the momentum in terms of economic recovery. And once that picks up, I think we'll be comfortable to bank some of these opportunities out there. But for now, our focus really is on all the large corporates, financial institutions in Singapore and the good jurisdictions.
Okay. Can I ask you a very specific question on oil prices and the impact on Singapore, whether it's on credit metrics for companies in the oil and gas service industry, and also generally in terms of inflation and the impact to the household?
Okay. So I think for us, I'll just talk about UOB first, right? Please. So for us, I think our loan book is about 4% to oil and gas, right? So we are pretty much comfortable with our oil and gas exposure. Rising naturally, rising oil prices is good for some of our borrowers. Yes. We opportunistically sort of increase our exposure. we opportunistically increase our exposure to this segment over the past couple of quarters, given that, high oil prices, they are able to service, their loans and all that. In fact, some of the analysts are expecting, potential write-backs from some of the write-downs that we have done, back in 2017, 2018, during the last oil price crash. So I think overall, pretty much we are all comfortable with the oil and gas exposure at the bank. The secondary effect is, of course, rising inflation, rising costs. You see that across the board in the economy. What this means is that, businesses got to be able to cope with this rising inflation, and whether they are able to pass that on to the consumers, that remains to be seen. But I think on the whole, we are comfortable with. We have done various stress tests and all that. I guess we have modeled in some of these assumptions. We are comfortable with, the borrowers on our side in terms of the impact from this inflation. So our bank's base case is that, there will be inflation, some inflation, and then there will also be some growth, but it will not be a case of stagflation.
Okay. That's good to hear that. And yes, I would agree. It should be the case that credit metrics improve dramatically, right, for the oil and gas companies. I hadn't realized that you had increased exposure over the past couple of quarters. I doubt it's good. I doubt it's, yeah. No, I think it makes sense. I would imagine other banks would have done the same. We don't have any more pending questions at the moment. I don't know if there are any final questions from the floor. I'm always happy to ask other questions. The immediate one that comes to mind is all about capital management, liquidity, and growth. So if we say that that right now this is recovery growth, maybe the pace doesn't remain the same for a long time. It's recovery growth. Your credit growth is very good at the moment. UOB's got a lot of capital. The loan to deposit ratio is very low. It's a very, very liquid bank. I understand that the dividend policy, as you mentioned in your presentation, is about 50% of profit. But how does the bank think about this in an environment where there may be subpar credit growth for a protracted period of time, and maybe when you've already done any acquisition that you want to do?
Sorry, so you are asking about how we are going to deploy capital?
Yeah,
right?
Exactly. You were mentioning that ROE you would want to get up from 10 to 13% over some period of years. But I'm just trying to understand, how do you manage your capital in a benign growth environment when you're very overcapitalized on most metrics?
So in terms of capital, I think management always seek to strike a very judicious balance across the different users, because we have different stakeholders to take care of and please, right? You have your shareholders who are looking forward to at least that 50% of dividend payout ratio, which we have committed to. Then you have credit rating agencies, we're in the midst of meeting them this couple of weeks, and it's important for us to maintain the AA ratings. And there are some rating agencies who expect CET1 to be at levels like 14%. So there are very high standards that we need to meet to maintain. We need to maintain a certain level of capital to meet the high standards. And then there's also growth, right? Loan growth opportunities amidst this economic recovery. If we don't bang this, we're gonna miss out and lose out, right? So these are three competing users of capital, which our management always seeks to strike a very judicious balance in terms of maintaining that delicate balance. There is no right formula, but I think so far we have been doing pretty well in how we are able to satisfy the needs of shareholders, credit rating agencies, as well as the long-term sustainability and growth of this franchise itself, right? So far, I think so good. Yeah.
Okay, that's good. That makes sense. That's great, Ida. I think that's all very clear. At this stage, Anisha, I would hand it back to you. We don't have any more questions from the floor.
Well, great. Thank you so much for a very interesting presentation, Ida, walking us through quite a few of the intricacies, of UOB, and Daniel for teasing out quite a few aspects given the current, general change in the regulatory environment as well. And to the audience for being very participative today as well and sending through quite a few questions. With that, I'd like to close the webinar for today, and we will see you all for our next one. And have a good evening, everyone. Thank you.
Thank you, Anisha. Thank you, Ida.
Thank you. Thank you.
Thank you very much.